Bloomberg News.
Joining us now, Robert Prechter, Elliott Wave International. Bob, welcome back to the program.
Yeah, good morning. How you doing, Tom?
Well,
What, do you have a 12-hour day?
It's just a 13-hour day today. Pim beat me on Friday. I'm looking here. Let me see the title of this book, Conquer the Crash. You Can Survive and Prosper in a Deflationary Crash and Depression. So we all went short. We all made a ton of money. How do you know when to get out of a short?
You know when to get out when the other side is getting a bit crowded. Back in 2007, 2006, it was the new economy. Everything was great. And that was the time because there were 92 to 98% bulls week after week among traders. Well, now we're down to 3% bulls, and I felt, look, that's enough. I said in the issue that I sent out Monday, this is early, that normally the wave structure should indicate an S&P down in the 600s. But as the old adage goes, bulls make money, bears make money, pigs never do. And I didn't want to be one because when the market decides to find a low, I think it's going to be a very sharp rebound. In the meantime, we're finishing off Wave 5, intermediate Wave 5 as we count it, which started in early January. It's got a little more to go, and that's where the market seems to be.
Robert Prechter, Pim Fox here. Is there any reason why people should be going long now?
No, definitely not. The bear market has only begun, at least the way I see it. Most people are looking at recent history and saying, well, in 1973-4, it was a little bit less than 50%. Going back to 1937-42, it was 50% drop, so the bear market's over. But I go by the technical indicators, and we need the right readings in market psychology. We need the right finish in Elliott Wave terms. And most important, and something that every investor can follow, we need to get the market back to reasonable valuations on the three major measures.
Is the market for gold at reasonable value?
Well, gold is in silver, precious metals in general, but particularly those two, have attracted a lot of buying recently, and at the same time I said, look, let's get out of the shorts. 800 points is a great trade in the S&P. I also said I thought that the metals were extended, and gold was at 1,000, silver was at 1,450 plus. Silver's dropped 10% since then, so that's a pretty good gain, and I think that's what I'm trying to do in a deflationary environment. Find areas that are overrun on the upside because in the long run, all these things have downside pressure.
He's Robert Prechter. He's been short. He's been right. Bob Prechter, Elliott Wave theory. Is it always right, or are there times where you go, wave theory is just not working?
Oh, man, nothing is always right. I wish it were. But for example, I was way early being bearish on the stock market. We've made mistakes here and there, but I also think it's the only tool that can sometimes pinpoint things for you, and it's the only one that gives you a context within which to think about the market from a technical point of view. I mean, you can throw fundamentals around all day, but, you can also armchair argue about what they mean. The wave principle, when it's speaking, is nothing like it. It's the most useful tool I've ever found.
What's the wave theory saying right now to you, Robert?
Well, the main thing that, of course, I was talking about through most of the 2000s when we had the largest and longest string of optimism ever in the stock market was that we were making a major top at a degree that we call grand supercycle. We haven't seen something like that for 300 years. Now, a lot of people said, well, there's no way that price patterns are going to tell you anything like that. But, I wrote a book ahead of time on this exact point and said, look, we're making a major top. It's all due to credit expansion, and that credit is going to contract as we go into the next phase, and that's what's happening. So I think it's been a good guide.
But Robert, isn't the government putting in all of the money that the credit system has taken, that is sort of burned through?
Well, not all. It's putting in much less than all, and that's the reason why we're still in net deflation, because the credit out there is imploding. The value of credit instruments is imploding, and the amount of new money that the Fed is attempting to inject, which really is only trading out, and of course the government has to take from one place to put it in. So net, it's not adding anything.
Well, you wrote a piece just a few years ago called Jaguar Inflation.
Oh, yeah.
Where you walk through Folks, I'm kidding. A few years ago, what was it, 5 years ago?
Four, yep.
Yeah, but you walk through the idea of using price as a tool. And as you say there, the credit that the government's putting in is maybe a very small part of the damage is made. Tell us about Jaguar inflation.
Well, one of the things that people have argued with me in terms of what I forecasted in the book is that, deflation can never happen because all the Fed has to do is offer more credit and that'll fix everything. So I said, how can I write an analogy that people will understand the reason why the Fed does not have unlimited power to issue credit? And what I said was, suppose the government decided everybody should own a Jaguar, so they created factories. They manufactured millions of them and sold them for half price. And everybody would say, oh, that's great. And pretty soon they're 1/4 the price, and people have 3 in their driveway. And pretty soon people have 5 apiece, and they're all parked in the front yard. And they say, well, look, we're going to give them away for free. So that's when people say, I don't want another car. Thank you. Well, credit's the same way. You can get it all the way down to 0, which is where Treasury bills are today, no interest at all. And people say, I've got enough credit. I'm in debt up to my ears. Thank you very much, but I don't want any more. And that's where we are today.
Bob Prechter, when you talk about unlimited credit from the government, why is that a bad thing at this time? This is not unlimited for unlimited amounts of time, but what's wrong with having unlimited credit right now to make up for the credit that has been destroyed in residential, commercial, and other real estate-backed enterprises?
Well, we do have unlimited credit. That's what the Fed has offered. The problem is that was the cause of our malaise today. We went for decades, for instance, 1933, and then accelerated in the 80s and 90s, offering credit, getting it all the way down to the price of 0. Well, we're saturated with credit. The economy was running on credit. In fact, from 2002 to 2007, when stocks rallied for 5 years, I said, this is a bear market rally. This is not a new bull market. And there are many, many proofs of that. One of them is from the Wave principle, but the other one is it was fueled by people borrowing, for example, off their homes. So there was nothing but credit running everything. And you can't fix the problem with more of the same problem. And they're trying to say, well, look, if we give you even more credit, won't that help?
So what is the wave theory telling you now? What is it saying to you?
It's saying we're in wave 5 down from the high in July or October of 2007. It's not over yet. We've probably got another month, a few weeks or a month to go, and then we should get a pretty sharp rally. But I also want to say that one of the reasons that I suggested we get out of the short side is not because I was really bullish on the market, although that's a possibility now that we're pretty compressed. The big reason, as I said then, was we want to make sure we get paid. And right now, all the brokers are depending on banks, to get paid. You might wake up a year from now saying, oh, I'm a genius. I rode the Dow all the way down 10,000 points or something, and then they call you and say, I'm sorry, but your money's not available. The bank's closed. Mm-hmm. So, there are a lot.
But do you really believe that's going to happen? I mean, the FDIC has already insured accounts to, 250,000?
Right, and they do pretty well when they've got one bank here and one bank there, but I think if 500 banks all of a sudden reported at the same time they were in trouble, the FDIC would have serious.
Do you feel that's going to happen?
Well, let's put it this way. I forecasted it in the book when there was no trouble on the horizon, and we've seen some extreme difficulties in banks. I think you just announced, or your show just announced this morning that
a dividend cut, right? They're trying to conserve money. There's no value in the dividend as far as the stock is concerned. People aren't paying up for the dividend,
right? And the bank stocks are still falling.
Robert,
I don't see the clear weather yet.
We've got 1 minute left here. What does a cathartic bottom mean to you? Within all your history, all your decades, this idea of we need a catharsis to know we've hit bottom, does that ring true to you?
Well, it's true at some lows, particularly, in crash lows, for example, you get volume tripling relative to the previous average. And I said, look, until we see, one of two things, that kind of washout, which is what we had in 1987, 1929, and a few other times in history, or a long period of extreme pessimism on lower volume with bears outnumbering bulls over, say, a period of a year or two. And neither one of those has occurred yet. I'll take either one, to suggest that it might be time to look at the market, but that hasn't happened.
Robert Prechter, thank you so much for coming on today.
Hear more Bloomberg News reports on the Bloomberg Terminal at AV Go, on Bloomberg Television, and on Bloomberg Radio. Copyright Bloomberg LP 2009.